In Chapter 10, we're looking at regulations, why these regulations exist, and the role that they serve. And what you see pretty quickly is that the reason for many of the regulations is because of the information asymmetries that we've talked about in the previous chapters, meaning that the firm that is offering a bond or an equity usually knows more about their internal operations than the potential investor does. And that's exactly what's being said here. So the government is getting, the government, especially after 1933, became much more involved in financial markets. And one of the earliest ways that it did get involved is what we see here with the Federal Deposit Insurance Corporation, or FDIC. One of the things that FDR realized during the Great Depression was that banks were able to fail too easily, and that it caused a whole bunch of turmoil in the banking and financial markets if individuals could spread false rumors and cause a bank to fail. So what was set up was basically a government-sponsored insurance corporation called the FDIC. And what the agency does is it basically um, um, collects premiums from banks, just like you and I would pay a life insurance premium or a car insurance premium. And then if something bad happens, like the bank fails, then the FDIC does one of two things. It either tries to find some other bank, a much stronger bank, to buy that bank, and that's actually what happens most of the time, or the bank completely fails. And if it completely fails, then it uses all of the collected insurance premiums to pay off those depositors in full. Um, I let's see. I've been on both sides of this equation. Um, when I was with the Federal Reserve, we did have to shut down a bank, and we did it on like a Friday afternoon, like a few minutes before it closed. We shut it down to stop, basically people panicking, and it was a bank that many people probably knew was a bit weaker, and basically it failed. And depositors receive up to the amount of the insurance, which at that time was $100,000. Today it's $250,000. Um, Fast forward a few years after that, during the 2008-2009 crisis, my checking account was with Washington Mutual, which was a rather large bank on the mainland, and it failed, and I don't know, I got my like $30 back that was in my checking account, but I did get it back, all the money, because no one bought it, and no one bought that bank out. Now, if the FDIC doesn't do what it's supposed to do, there still is another safety net, and that's what the second bullet point is highlighting here. And that would be that the Federal Reserve can always step in as well and act as a lender of last resort and provide funding for the bank. Um, most, I guess the evidence is a little bit mixed. Um, some research seems to suggest that the FDIC really hasn't helped the financial system be better or prevent banking crises. Um, it doesn't, just the existence of insurance on its own obviously can't prevent a banking crisis, which is usually caused by something else. But what it does, I think, and this is not on the slide, this is just my sense of things as a scholar in banking, is that it sends a signal. It sends a signal that the banking system is strong and that the government is going to be involved enough to make sure that its protection, that its insurance of deposits is going to not become burdensome. We have other examples where, the FDIC didn't cover everything. There was a pretty significant banking crisis in the United States in the mid-'80s called the savings and loan crisis, where the deposits weren't explicitly insured. But the federal government actually did step in and provide the insurance anyway. Because to let the savings and loans bank institutions fail and depositors lose money would cause a loss of faith by depositors in the banking system in general. And so I disagree with this slide that it doesn't improve the banking system or the financial system. I think it does, if only by increasing faith in the system. Now, it's by having this, depositors, as long as depositors know that there's insurance, they really don't investigate too much about the strength of that bank, right? Because if all deposits are insured, it really doesn't matter who your bank is. I mean, I can, off the top of my head, I won't say I'm in this video lecture, but off the top of my head, I can identify for you at least one bank on the mainland and one bank in Hawaii that is weak, and that if there wasn't deposit insurance, there's no way I'd put my money anywhere near that bank. But because this insurance system exists, the bank continues to exist and collect deposits. So there is an extent to which there is moral hazard. That bank is as strong as any other bank, at least in terms of deposits being insured. Also, if I wanted to start a bank, as long as I'm meeting the different regulations, I could be rather risky in how I lend out my money. And I could also name for you some banks on the mainland and even here in Hawaii that I think are lending in ways that are not advisable, are not strong. But the bank knows that depositors aren't going to really care because they know that their deposits are insured. So the insurance, unfortunately, does have a negative consequence of not making people behave as they should. Just as having car insurance might cause a person to speed, or having health insurance might lead a person to eating unhealthy. It's not the root cause, but it doesn't stop a person from self-regulating themselves. The problem that has emerged, though, and it was especially apparent in the 2008-2009 crisis, was that there are incredibly large banks in the United States. In fact, there are 7 of them that are considered such big institutions, financial institutions, that they are not allowed to fail. The government has already stated that it will intervene and it will purchase that institution and it will not allow it to fail. That means that those institutions that have been defined as too big to fail are going to act riskier. And that is actually the world that we live in today. So if you want to feel scary about anything, it would be that we have institutions that are large enough that they are not, they don't face enough of an incentive to behave appropriately. Let's see what those places are here. There are 7 of them. There's obviously a movie about them. It's a pretty good movie. No JP Morgan's on the list. So here we have 29 banks. Now these would be around the world. Actually just looking for the list of 7. Well, I guess we have this here. The 11 largest banks are not going to be allowed to fail. But it also looks like we have other examples of other institutions that are not going to be allowed to fail. That'd be Bank of New York Mellon, Citigroup, Goldman Sachs, JP Morgan Chase, Morgan Stanley, State Street, and Wells Fargo. I don't know how many that is, but Morgan Stanley. I don't know if I said Morgan Stanley. Hopefully that's pretty darn close to 7. Rather large institutions that are not going to be allowed to fail. And if we think about what caused, what was a problem in the 2008-2009 crisis, part of it was that Lehman Brothers was allowed to fail. And that's kind of the one of the lessons learned. What that means as well is that if these institutions are deemed too large to fail, you need to regulate them more. You need to make sure that they're not being too risky in things that they take on, which is going to cause some resistance because those same institutions that have been defined too big to fail are also profit-making institutions that make money to the extent that they take on risks. The way that you would try to regulate these banks and would be, again, primarily by controlling what kind of assets these institutions hold. So you would engage in asset management. And you would, for instance, prohibit the institution from holding certain kinds of stocks. You would prohibit the firm from being too overly concentrated in a single industry or in a single stock. You would require that the firm have some level of leverage, meaning some level of capital in order to carry things out, and that it would undergo what are called stress tests, meaning if things happen in the economy and the markets adjust by a certain amount or loans adjust by a certain amount, that bank, according to computer simulations, can still maintain operations. In terms of the capital requirements, you would do this with either risk-based capital requirements or you would do it based on a leverage ratio. So a leverage ratio would be basically saying how much money do you have compared to how much are your total assets. Those assets are generally lent out. So how much is your lending? And you want it generally to be a little bit, in this case, you generally want it to be higher than 5%, meaning that you have about 5% of your book of business as cash or readily accessible capital. Otherwise, you're just operating too lean. What you could also do is you could adjust those capital requirements based on their riskiness, right? So cash has no risk associated with it. But if I said that my capital assets were some certain bonds, and those bonds had some chance of defaulting, then I should have to hold more of those just in case they did actually default. One of the things that was attempted to get some sort of global harmonization was the Basil Accord. Basel is a city in northwest Switzerland, and what the Basil Accord, what the Basel Committee on Banking Supervision, it contains members of basically the largest central banks and regulatory agencies from around the world. They meet in Basel, Switzerland. It's many of the 20 largest countries in the world. And they basically make recommendations. They make recommendations that banks and financial systems should have for how strong their financial system should be. And they can only make recommendations. They have no enforcement structure, but most of these recommendations are generally taken up by the countries. There's a Basel I, a Basel II, and a Basel III, which just started, I believe. These Basil Accords have 3 pillars. When we look, the first pillar is all about the capital requirements. How much should a large internationally active bank, how much should its capital be based on the market risk it's taking on, the credit risk it's taking on, and its different operational risks? So what are the capital requirements? Second, what's the supervision? Supervision meaning the regulatory agencies basically keeping in touch, making sure that it's the institution is doing what it's saying it's doing, and that it's maintaining certain operations. And then finally, that we have some idea about how things are disclosed. How are we getting the information about the amount of reserves it has, the capital it has, how good is the bank itself maintaining its own supervision of itself. And it adjusts over time. So that's why we have a Basel I, 2, and 3, because things are changing over time as the markets become more global, but also the types of capital change as well. The biggest thing that can really be said about financial supervision is, I guess I put it akin to, it's kind of like having clean teeth. You just got to stay on top of it, because if you don't, the problem's only going to get worse. So you really don't, the first time the FDIC approaches a bank shouldn't be when it's about to fail. It should be intervening much earlier. Unfortunately, this is my own criticism of this, unfortunately, there's a fair amount of what economists also call regulatory capture. And in regulatory capture, basically the banks get to know their FDIC representatives very well, and they start to take over the agenda, the supervisory agenda of the FDIC. And it causes this agency to not be as effective as it should be. In chartering in the bank, meaning starting a bank, and in examining the bank, which happens on a pretty regular basis, what you're trying to do is you're trying to remove two types of asymmetric information: adverse selection and moral hazard. So in the chartering process, you look at, why are you starting a bank? What is your motivation? Why are you doing this? What that avoids is adverse selection. That problem of adverse selection. For instance, if I know that I'm a bad driver and I'm looking for car insurance, the car insurance company is not going to really want to insure me because they know I like getting in accidents. Same with the banks, right? So if I want to start a bank because I would say something like, I like playing around with other people's money, that's not showing that I'm very responsible. So I shouldn't be given a bank. In the examination process, what we're trying to avoid here is the problem of moral hazard, meaning that the bank knows more than the depositors. And so we look at the books, we look at their asset quality, we look at their earnings, we look at their liquidity. The nice thing about all of this, actually, is that you can go on their website and you can actually get a great deal of this information yourself. Let's see here. Under the resources, yeah. I can look up Banco. And I can see its FDIC certification number. I can see how long deposits have been insured since. I can see who its regulator is. I can look at each branch. I can see when that branch was established. Digging deeper, I can actually even see how much in deposits each branch has. And here I can then start to call up all the different reports. So like I said here, I can see how much are in deposits at each of the different branches. My branch is the Manila branch. Let's find it. East Manila Road has what, $189 million in it in deposits. Not too shabby. Anyway, all this information is available, and even this is as of June 30th of last year. You do have different policies for controlling the risk. So in terms of the bank making loans and in terms of how banks accept deposits and what they do with those deposits, they have different internal controls that they have to meet, but that the regulators also require as well. So when they're lending out money, that they're lending it out appropriately. These banks all use mark-to-market accounting, fair value basically, which is a safer way of trying to measure the value of your assets. They're all subject to, if you remember, I called it SOX, the Sarbanes-Oxley Act, which again requires that the corporate officers in the bank have to sign off on all of the accounting reports and vouch that they are in fact true. The Securities and Exchange Commission, as well as the FDIC, depending on whether you're an investment bank or a deposit bank, tries to harmonize how it does these regulations, so that you have the same kind of accounting standards being used and practiced. Okay, now we turn to the consumer protection. So in the consumer protection, we're looking at how when we all go out to get loans or we engage in certain financial transactions, what are the sorts of protections that are out there? And one of the earliest ones was the Consumer Protection Act of 1969, which is also called the Truth in Lending Act. What this one did is it basically set up the rules for how debts are collected, how credit events are reported to the credit agencies, how wages can be garnished if you haven't paid something off, and it provides some explanation of finance charges. Meaning, right, you're like borrowing from a credit card, not paying it off in full. That was followed up in 1974 with the Fair Credit Billing Act of 1974, which is kind of around the time you're really getting credit cards being used more often. The first credit card in the United States being American Express. With the Fair Credit Billing Act of 1974, you get a federal act that's basically protecting consumers from unfair credit billing practices, gives you certain protections for like unauthorized charges or goods that aren't delivered correctly. Then for the Equal Credit Opportunity Act of 1974, you have basically a law that's stating that banks will not discriminate on the basis of race, color, religion, national origin, gender, marital status, age. So basically it ensures that everyone has equal access to loans. And then that's followed up in I think it's the 1990s, with the Community Reinvestment Act, which requires the Federal Reserve to encourage institutions to meet the credit needs of the communities where they're at. I was somewhat involved in this when I was at the Federal Reserve. Not to be a pessimistic person. The Federal Reserve seemed to care about it, but their heart's not in it. Right? They're a regulatory agency for making sure that banks aren't, making bad loans. Not dictating to banks how they should be lending their money or where geographically they should be lending their money. And this one's a hard one. And Hawaii actually has a special history with this one, because we used to have a mainland bank here in Hawaii, Bank of America, in the late 90s. And when they were here, they made a promise based on the Community Reinvestment Act that they would lend money to Native Hawaiians. And they never did. And there's no enforcement. So, basically, right, the long and short of it is that the Bank of America doesn't care anymore because they're not here. The Federal Reserve's not going to enforce it. So it's kind of like window dressing. It's designed to make everyone feel better, but it doesn't really do what it's supposed to do, in my humble opinion. What you see as well is that there used to be more limits on how banks operated in terms of their competition, and a lot of those have gone away. There were restrictions on the branches that could be established. That limit was eliminated in 1994. So you saw you saw regional banks becoming much more national. And then you had the Glass-Steagall Act being repealed. They mean repealed, not repeated. Repealed in 1999, which eliminated the division between investment banks and deposit banks. And so what that did is it allowed depository institutions to engage in slightly riskier behavior. Or, in another way, as the second bullet point highlights, by telling banks that you had to limit your branches, or by telling banks you can only invest in certain things, it could cause higher consumer charges or decrease the efficiency of the bank. But I would say the advantage would be is that the banking system might have been a little bit safer with them. Sorry if I'm becoming a little bit too opinionated here. It's just there's obviously a great deal of debate about these things. One of the challenges that's a bit before my time of when I was involved with the Federal Reserve comes from international operations. We have banks, obviously, in the United States that do have international operations. Those largest banks that we saw there, they all have international operations. But in general, the international exposure of many American banks is much smaller than European banks, for instance, with their American operations. So it's difficult for the Federal Reserve, the FDIC, to understand the extent of the risk and managing that risk for the international operations of banks. And so some banks just don't want to get involved in this kind of complexity and just reduce their size of their international operations. Many of these I've already talked about. Again, most of them really start to come about with the Great Depression and starting in 1933 with things like, again, the FDIC. And so you see in 1930, especially on this slide, you see a large extent of imposing regulations. So that's what's here. And then you see starting in the 1980s, you see a scaling back of that. And that would be obviously with the Republicans and the Reagan administration, where the banking institutions wanted to get rid of all of the regulations they were being faced. And that's really what you see here. Such that the banking system that we know today looks nothing like what banking institutions looked like 50 years ago in terms of the regulations they face. They faced far fewer regulations. Again, I'm assuming you can all read here. You don't need me to read this for you. But you see, again, scaling back of the supervision, scaling back of the supervision, up until 2002. Sarbanes-Oxley occurs because that's when Enron Bank fails, or not Enron Bank, Enron, the energy company, fails. So unfortunately, what you see is that things happen as a reaction to something else. 1933, It's all a reaction to the Great Depression. We could actually go back here. Things that are all talking about the savings and loan crisis is all about, because those savings and loan banks were failing, that they created some structure to protect them. 2002, Enron failed, and then obviously 2010. 2010 is where you get the bulk of things because of the 2008-2009 crisis. So I like regulations as much as the next person, just to protect things. But you have to remember as well is that regulations have a political character to them. And so oftentimes they are the prescription to a problem that voters see in the financial system when a banking crisis or a financial crisis happens, is that everyone thinks there weren't enough regulations. This is what we need to do now. And then people forget about it, right? Which is basically what happened in 1980. And I'm sure fast forward from 2010, we do see a scaling back of that actually during the Trump administration to some extent. So in some sense, this should even be updated for the Trump administration, as people forgot about the 2008-2009 crisis. Okay.